Hey everyone, welcome back to Corporate Decoder. I just filed a new credit agreement and I am seeing a key detail about their borrowing power. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is taking on a big new credit facility and it tells us something about how they see their future. Alright, let's dive into this filing from Acuity Incorporated. This is an 8K report, which means it is for important events that shareholders need to know about right away. The big news here is about Acuity Inc, sometimes called IE on the stock market. They've just signed a new credit agreement. Think of this like a new business loan, or in this case, a credit line that they can draw on if they need money. This new agreement replaces an old one from 2022. It sets them up with a revolving credit facility. That sounds fancy, but it essentially means they have access to up to $800 million that they can borrow and repay as needed. This facility is set to mature in May of 2031, which is a pretty good leash. The deal was officially made on May 8, 2026. Just to give you some background, Acuity Inc has common stock trading on the New York Stock Exchange under the symbol IE. So, what does this new credit agreement actually mean for the company? It is considered a material definitive agreement, meaning it is a big deal. It is an unsecured revolving credit facility, meaning they are not putting up specific assets as collateral. JPMorgan Chase Bank is the main bank handling this deal as the administrative agent. This new facility gives them access to up to $800 million. This is a significant amount of money that provides them with financial flexibility. For context, Acuity Inc has a market cap of roughly $8.8 billion. So this credit line represents about 9% of their market value. This shows the company is securing substantial backup funds. The agreement mentions that this credit line is guaranteed by their main domestic subsidiaries. This is pretty standard practice. It means these subsidiaries share some responsibility for repaying the loan if Acuity Inc itself can't. Now, let's talk about the cost. The interest rates on loans drawn from this facility will be based on various market rates like SOFR or Euribor, plus an applicable margin. This margin can change based on either Acuity's leverage ratio or their credit rating. A lower leverage ratio or a better credit rating usually means a lower interest rate, which is good for the company. What is interesting is that Acuity gets to choose whether the margin is based on their leverage ratio or their credit rating. This gives them some control over managing their borrowing costs. They also have to pay a quarterly facility fee, which is based on the total amount of the credit line, regardless of how much they actually use. This fee also adjusts based on their leverage ratio or credit rating. Like most big loan agreements, this one comes with strings attached. There are restrictions and covenants Acuity Inc has to keep its leverage ratio below a certain level. This means they can't take on too much debt compared to their earnings. There are also rules about selling off major assets, taking on more debt, or merging the company. The key financial covenant here is the maximum leverage ratio. It is set at 3.75 to 1.0. This means their adjusted debt minus their readily available cash can't be more than 3.75 times their yearly earnings before interest, taxes, depreciation, and amortization, also known as EBITDA. However, they can temporarily bump this limit up to 4.25 to 1.0 if they make certain big acquisitions. This is a flexible feature, allowing them to finance growth through borrowing if needed, but within tighter limits during those acquisition periods. For comparison, many industrial companies operate with leverage ratios below 3.0. A ratio of 3.75 is moderate, and the ability to stretch it for acquisitions suggests a growth-oriented strategy. Of course, there are standard events of default. If Acuity Inc breaches these covenants, the lenders can stop lending money and demand all the borrowed money back immediately. And in cases of bankruptcy or insolvency, the entire debt becomes due automatically. This filing also falls under item 2.03, which specifically covers the creation of a direct financial obligation. Everything we just discussed about the credit agreement is the core of this section. Finally, the filing lists the exhibits, which in this case includes the full credit agreement itself, marked as Exhibit 10.1. This new credit facility is a substantial vote of confidence from the banking sector, providing Acuity Inc with significant financial flexibility for the next 5 years. The $800 million capacity and the terms around leverage ratios suggest a company that is planning for growth and understands the importance of managing its debt prudently. The ability to temporarily increase the leverage ratio for acquisitions is particularly noteworthy, pointing towards potential future expansion efforts. While every loan agreement has risks, the structure here appears standard for a company of Acuity's size and industry. What is really interesting to me is how this aligns with Acuity's strategy. They are a major player in the electrical equipment and parts industry, and having this kind of credit line ready can help them weather economic downturns or capitalize on acquisition opportunities quickly. It shows they are thinking ahead and preparing for various scenarios. The fact that they replaced an older agreement with this larger, more flexible one in 2026, with a maturity in 2031, suggests confidence in their long-term prospects. A 3.75 leverage ratio is not overly aggressive for an industrial company, and the provision for increased leverage during acquisition signals a proactive approach to inorganic growth. My biggest concern is always about how companies manage debt, but Acuity seems to be balancing borrowing capacity with covenants that keep them in check. The critical factor will be how effectively they utilize this facility and whether any future acquisitions generate the expected returns to justify the potential increase in leverage. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Find our Discord in the description.